Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Cameron May, 20 plus year veteran of the financial market. He's there to facilitate the conversation. And I am joined also by so many of you who are great traders and great students and a great community out there in the chat. So thank you to all of you who are here with us on a regular basis. Also, if you're brand new, welcome. It is a welcoming environment. It's a great community. Be a part of the community. Continue to chat in your questions and your comments along the way. Put in a couple of hearts in there as well. Those are important. And we do have a very welcoming community here. So Cameron's going to be helping to facilitate that. And guess what, guys? It is Fed Day. We got a lot of stuff to talk about here ahead of the Federal Reserve meeting. So we're glad to have all of you with us, whether you're in the live version or the recorded version. It doesn't matter. You can also follow me. You can also follow Cameron and all of the other education coaches on X. I'm at Ben Watson CS. Cameron is at Cameron May CS. He's posted those at the top of the chat, so you can go in and follow those as well. A couple of quick reminders, though, as we get started. Remember that everything we talk about simply for illustrative and educational purposes only. It's not a recommendation. It is not any kind of advice. Remember that past performance, no guarantee future results. Now, we're going to talk about equity and index options today, specifically index options. Remember that those carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Now, we're going to use the Thinkorswim desktop software platform today, specifically the paper money version of which. The reason I bring that up, number one, it's a great learning environment. Number two, it's not a guaranteed future success out there in the real world. Number three, the paper money environment does not do certain things that a live trading environment would do. One of the biggest of those issues that the paper money environment does not facilitate is the early assignment of short options. Remember, anytime we are short an American style option, we can be assigned up to expiration, regardless of whether it's in the money, at the money, out of the money. It doesn't matter. Now, in this class specifically, we are going to be focusing on index options that are primarily European style, not American style. European style options cannot be exercised until expiration, which removes that early assignment risk. However, I don't want you to think that as you start to trade other options or you're trading equity options and you run across an American style option and all you've done is do it in a paper money account, or all you've done is trade equity options and then you get assigned early on an American style equity option. I want you to make sure that you understand that that can and does happen. So be aware of that. Now, as we talk about things like technical analysis in this discussion, probability analysis, all of these are theoretical. None of these are guaranteed. And because of that, Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Also, when we talk about stops, it's important to remember that stop orders do not guarantee the execution price. Stop limit order does not guarantee that the order is in fact going to get executed or filled. So let's jump into the discussion today. Let's pop over to our Thinkorswim desktop software platform. Take a look at what's going on in the market here. We're a couple of hours in advance of the FOMC announcement. And we'll see the impact that that's having. It's kind of a chilling or cooling impact, perhaps, on the market as a whole. So we take a look at the SPX really quickly to add some context to this discussion. So we take a look at what's going on. The market is fairly sedate this morning. A little bit of a gap down and a little bit of a sell-off into this kind of almost doji candle at the moment. The RSI coming back off from that overbought, from underneath that overbought line. And so it's kind of sitting here on the S&P 500, the broad market index. Taking a look next at the NASDAQ. And Jay Richardson, welcome to all of you. We're glad to have you here for your first time. We hope that you find this is a worthwhile place to be. The NDX, the NASDAQ index, kind of bouncing down perhaps from a little bit of a resistance level that we saw earlier in the week, Monday and Tuesday. Yesterday, we saw that little bit of a gap up and a little bit of a rally to the open there. And then it sold off, and we see a little bit of a continuation there. So again, maybe some positioning ahead of the FOMC meeting. Now, this is, and as I talked with Kevin Horner this morning on the Trader Talks webcast, we said probably the most widely anticipated unknown event ever, in that the expectation for this FOMC meeting is largely expected. And when you look at the Fed funds futures, when you look at the CME Fed fund or Fed watch tool, all of those suggest that there's a high likelihood of a rate cut of some type in today's meeting. Politically, there's a high likelihood of a rate cut in today's meeting. That's also likely been baked into the market, into that expectation. So there could potentially be a kind of that buy the rumor, sell the news perspective, that once the rate cut is announced, there is perhaps a little bit of a sell-off in the market simply because of that now bad news is bad news perspective. Taking a look, however, at the Russell 2000, and this is maybe the kind of differentiator here in the SPX, the broad market index, the NASDAQ, the tech-heavy index, and the Russell 2000, which kind of cuts a cross-sectional swath across small caps, but does have a higher concentration in technology in the small caps than it did last year or the year before, starting to see some upward push. The anticipation being that small caps are perhaps more responsive to interest rate cuts because small caps perhaps are more sensitive to borrowing rates, for instance, and to debt service loads. And so when those rates go down, theoretically, these companies benefit. Now, the other side of that coin is kind of a conundrum, because the Russell 2000, this index, also contains a fair component of regional banks that sit within the S&P 500, or excuse me, within the Russell 2000. Those regional banks not only benefit from higher rates because of their lending activities, but they're hurt by higher rates because it curtails their lending activities, if that makes sense. Less people willing to borrow money to buy cars, which is where a lot of those regional banks focus, to buy homes, which is a lot of where the regional banks focus. And so a rate cut from a perception standpoint could ease things up for those regional banks and could move this index higher, which in fact, what we're starting to see in today's move. You kind of see this little bit of a, again, we see a bit of a squeeze. Pat Mullally and I used to call this a cobra pattern at the top of an uptrend. And we see that little bit of a pop to the top of that pattern back up to that resistance level, not to the all-time high yet, but still some upward movement, and an RSI that has a little bit of room to go until it gets to that extreme. So seeing a little bit of upward movement in the Russell 2000. Now that's going to become significant in terms of the one of the strategies that we already have on, which is a long call diagonal spread here on the Russell 2000, much like a covered call where we, or a poor man's covered call where we own the stock and then we sell a call option against it. In this case, we can't own the index, but we can own an index option and then sell an index option against that. So we'll look at that particular strategy here. One other thing I wanted to look at really quickly before we drop into specific strategies, and that is this. I wanted to take a look at the VIX, the volatility index, and we've talked about the VIX on a regular basis. We talk about it week after week after week, and there's a reason for talking about it week after week, because it has a large impact, theoretically, on options and a large impact on certainly index options. In fact, we've even traded the VIX index, traded options on the VIX index as a part of this class as well. But starting to see a little bit of a rise in the VIX. It's moderating today, but yesterday and the day before were solid upward days in the VIX, putting the VIX back up above now sitting in about the mid 16 handle, but back up above its moving average. The blue line that I've got on there is a 30-period moving average of the VIX, which in and of itself is a 30-period average of in the money, at the money, out of the money options on the SPX. So VIX is a little bit higher, a little bit more expensive than it has been. The volatility of the VIX is a little bit higher as well than the VIX. And this can be oftentimes, when you get this disparity between the VIX itself and the volatility of the VIX, a precursor to a spike in the VIX. When you get that jump in that disparity, then you can have potentially that increase, because it suggests that the volatility of the VIX is growing and the likelihood of the VIX to make a move. And generally, we don't see spikes to the downside in the VIX. We typically tend to see spikes to the upside as a result of exogenous events or news events. This could be one of those news events. If the Fed were to come out and say, no, we're not cutting, I think perhaps we could. And again, this is what technical analysis would suggest. I'm just playing the if this, then that. If there was a lack of a Fed cut, which is highly anticipated, that would be unusual, and that may create a spike in the VIX, which means that implied volatility goes up on SPX options, but also means that implied volatility goes up likely on a lot of equity options as well. But we're focusing on index options in this particular class. But I wanted to bring that up. The volatility of the VIX is higher. There's a big disparity between the VIX index itself and the volatility of that index, and that suggests a greater expectation of movement in the VIX. So could we get a spike? Yes. Is it likely that we're going to see a spike of the magnitude that we saw back here in the tariff announcement in April? No. Is it likely that we're going to see a spike that we've seen in the VIX, maybe back up into those 20 handles, but who knows, right? And that simply is just looking at what it has done in the past, not a guarantee ever of what might happen in the future. Also, but I do know what can be happening in the future right now is you filling out our feedback survey that just popped up into the chat. Cameron's going to repost that. He's also going to pin it to the top of the channel so that you can see it. And we would highly encourage you to fill that out. That helps us out, make these webcast sessions better for you. The other thing that makes this better for you is clicking on that subscribe button down at the bottom of the page, because then you can stay connected and it's at no cost to you. We'd love to have you give us a follow that way. All right, so let's go over here, first of all, to our monitor tab and take a look at what we've got currently on. I want to address our 14 days till expiration, 7 days till expiration strategy first of all. And we'll get that out of the, not that we'll get that out of the way, but we'll take care of that in quick fashion. And then we'll address moving into some of these other indexes. So taking a look at the SPX, here's the strategy. For those of you who are brand new, welcome. This is something that we do on a weekly basis. We sell a 14 days till expiration short vertical spread on the SPX. And we either sell a put spread or we sell a call spread, depending on what our directional bias is, bullish or bearish. If our directional bias is bullish, we sell a put spread. If our directional bias is bearish, we sell a call spread. In this case, our directional bias is still bullish, so we're looking at selling another put spread in this case. We sold it last week for $1.60. It's now trading for 75 cents. So we're going to be able to pick up theoretically about 50% of our max theoretical gain. Sometimes we get 80%. Rarely do we get all of it. And sometimes we take a slight loss in this strategy. So the first thing that we're going to do is we're going to close this vertical spread down. Now, I know we could do this in one single order with a rolling order, but rolling orders are not magic wands, and rolling orders are there for convenience. I'm here to teach this, not to be convenient, so I want to show you how to do this separately. So we're going to close down this vertical spread by right-clicking and creating a closing order. We're going to try to get this for 75 cents. If we can buy this vertical spread back for 70 cents, let's go 70 cents or better, which means that we're going to get about half of that premium that we brought in to begin with We're not going to let this expire worthless or try to go to expiry because we're still carrying the risk of this trade all the way into expiration until we close it down. So I'm going to click on confirm and send. We're going to read through this order, make sure that this is what we want to do, make sure that order is to close, and click on send. And yes, this is being recorded for sure. So we got it for 70 cents. We closed it down for 70 cents. We picked up half of that, about 50% of the max theoretical gain in the trade that we were expected to pick up. Now, here's what we're going to do next, is we're going to look out over the horizon and we're going to say, where is the next expiration that puts us at 14 days to go until expiration? And that's the 1 August expiration. That's the 1st of August. That's a Wednesday. 14 days to go until expiration. Because we teach this class on Wednesdays, that's why we're using these Wednesday expirations, 14 days to go until expiration. The reason for 14 days, it's a balance between the amount of premium we're bringing in and the length of time that we're in the trade. We're selling these out of the money, which means that they're going to capture the majority of their time decay, which is really what this trade depends on, in the initial first week of that trade. So that's why we're selling 14 and buying back at 7, come what may. So that's the basis of the strategy. And if you go back to some of the archives, you see some of the math that we've done. The probability of success here, we're selling out to about the 15-cent delta, 17-cent delta in some cases. So we've got about an 85% probability of success in these trades. Now, has that borne itself out? I would argue, yeah, I haven't done the math, but I would argue that that's probably realistic. Now, given the fact that we take this trade off at 14 days, maybe it's even a little bit higher than that 85% probability, because that delta assumes at that probability at expiration. Now, it's not a guarantee. Delta is primarily a function of the sensitivity of the option premium to directional price movement. It is used sometimes by traders, and in this case used by us as a proxy for probability, but it is an approximation for probability, but it is not exactly that probability component of the option Greeks. So let's do this. We're going to go to the charts again. I'm going to change my layout to my index options grid, and I've already got it preloaded with the SPX. And so you can see what we've been doing. Left-hand side chart, for those of you that are brand new here, is this diagonal, or this blue line. That's our, I think, did I say that's the 200? Let's take a look. Yeah, 200 period moving average. So when the index is above the 200 period moving average, we are bullish. When we are below the 200 period moving average, we are bearish. That's the directional toggle, okay? So given that, we're still selling put spreads in this case. Where this strategy does not hold up generally is in the transition time between the above and below the 200 period moving average. So we may need to tweak it as we get, if we find another scenario like that. So you can kind of see where we've been selling those. I've left those crosses over each time where we've been selling those. And that's how we're going to accomplish this. So I'm going to go to the next chart in the grid, which is our 3-month daily. Still a daily chart, but I've added a probability of expiring cone. So I'm going to show this because Jerry asked the question, what's the time and length of the probability of expiring cone? So I'm going to go to my Flask icon here. Probability of expiring cone is the tool that I have on here. And if I go to the gear icon, we can see that. So the period is 30 days or 30 periods. By default, it's 100 periods, but I didn't want that much room over to the right-hand side of the chart because we're only selling out 14 days. So I wanted to just concatenate that a little bit. But you can make it 100 periods. It doesn't change the length of, or doesn't change the probability range. Probability range is 68% probability, which is one standard deviation. So where this probability of expiring cone arc is the one standard deviation level above or below the current price of the stock. Current price of this, or the index in this case. Remember, this is a cash secured index. The SPX is a cash secured index. The options that we trade on the SPX are cash settled not cash secured. Did I say cash secured? Cash settled index. Okay, cash settled index. So these options are cash settled. So at expiration, they're going to be worth either intrinsic, which is going to result in deposit of cash, or zero, which is going to result in nothing. Or if we're short, they're going to result in a debit of cash out of the account or zero, right? So that's the nature of a cash settled index options. Okay, so as we look at that cone, each week what we do is we draw a timeline. This is a time level. So I'm going to delete this one, and we're going to grab that timeline tool right here. This is our time level. And I know I'm going to go out to the 1st of October. There's the 1st of October, and I'm just going to put a time hack there. That's our 14 days to go until expiration. And what I'm going to do then is I'm going to grab my line tool, and I'm just going to do the crossover between those two. The intersection of those two happens to be right at the 6,400 mark in this particular case. There's the 6,400 mark, and you can see that because of implied volatility is a little bit elevated. We're at nearly the same level that we were before, even though the index has gone up from where we sold the last one a week ago. So we're going to look at selling a put spread, beginning with our short strike at the 6,400 strike price. So we're going to go back to our trade tab, and we're going to go out to the October expiration. And we're going to have to add some strike prices here. We're going to add out about 100 strikes. So that's going to be 50 up and 50 down. And here is our 6,400 strike. There's our 6,400 strike. Right now, that's about the 16-cent delta. And pretty high rate of theta, pretty high sensitivity to implied volatility. So if implied volatility spikes, this could work against us. But if implied volatility falls, so what could harm this particular spread would be a big move to the downside in the market and a big spike in volatility, both of which are possibilities. So we want to recognize that. Now, as we're looking at this, so we're going to go to the 6,400 strike. We're going to sell the 6,400 strike. And again, not terribly wide bid-ask spreads here. This is probably one of the most liquidly traded indexes. So we're going to sell that 6,400 strike, and we're going to keep this 20 points wide. So I'm going to buy the 6,380. And so we're going to bring in in this case, about $1.80 of credit. So we got about that same level, right? High probability of success, small amount of premium. This is not a home run trade, but this is again and again and again and again generating income on an ongoing basis. And so we're going to look at selling that for $1.80. We're going to click on confirm and send. We're going to read through this order, and we're going to make sure that we read the order, make sure that it's to open, sell one vertical spread, the 1 October expiration, 6,400, 6,380 put strike. We're going to do that for $180, right? $1.80 times 100 shares. Or 100 increments, because this is a cash settled index. Our max theoretical loss in this trade is 1,820. Okay, that is the $20 width of the spread minus the premium that we're bringing in. So bigger theoretical maximum loss. But you got to remember that maximum loss sits there throughout the lifespan of this option until we take that trade off. And so there is that potential risk. And that's one of the other reasons why we buy this back at 7 days, to eliminate that risk as we get closer to expiration. But we're doing this so that we can do this on a weekly basis, on a consistent basis. So we're going to put this in our advanced index options weekly group, recognizing that we're not likely to take that max theoretical loss unless we get that big giant move in the market and a big spike in the VIX. So let's click on send. We'll fire this order off, and we'll see what we get for it. And we sold it for $1.80. And now we know where we are on this vertical spread. We go back to the chart. We sold right here. Our expectation is, just to kind of line this out for those of you who've not been here with us before, our expectation is that the market, which is right here, the SPX, is going to stay at or above that 6,400 strike for the next week, essentially, for the next week. So that gives it a fair range to pull back even in that event to move against you, right? So that is the scenario. Now, Rick says, would it make sense to wait until after the FOMC announcement considering the VIX could spike? Yes and no, because at that point, the VIX could also crush and we might not bring in as much premium. So we are, and we've done this a couple of times before. We've, in the course of this class, we've had a couple of FOMC announcements over that time, and we've always done it in that time frame before the announcement. Now, we could, and so Gary, to Jerry's point, to the point here, you could wait, and there's nothing wrong with that. Now, here's the thing: if the VIX spikes on the announcement, that could give you the opportunity to sell a fair amount of premium and then still have the index continue to move in the direction that you want it to go. But the FOMC meeting is a little bit like an earnings announcement if you think about it from the entire market's perspective. Implied volatility is elevated right now, and that implied volatility could go down once the meeting has concluded. If expectations are met, that VIX could drop, and that could suck that premium out that we're looking at here. And so we could see our gain realized relatively quickly as well. So, I mean, there's no one best way, no ideal time necessarily, but as a matter of personal preference, you're absolutely right. This is a big event and a big event risk. So thinking about it in terms of when you sell this strategy is an important consideration. So that's what we've done so far. And that's our trade. Let's go back to the monitor tab. Here it is. It's already going up against us. You're absolutely right. Could we have waited? Yes. It's kind of waffling around, and I suspect that this is going to stay fairly close to that price until after the announcement, unless the market makes a move. But then we're going to see time decay kick back in, and you could hedge this off. You could create an iron condor. You could create a straddle, strangle swap, whatever you wanted to do. I mean, you could do a number of things. This is the foundation of this particular strategy. Okay, that's number one. Number two, the next thing that I wanted to do is I wanted to take a look at this one, which is our Russell 2000 long call diagonal. We've got a long call at the 23.55 strike. 37 days to go until expiration. We have rolled this out for a little bit of duration, and we rolled it and booked some potential theoretical gains on the trade. That has now increased in value, not only because volatility has gone up, but also because the index itself has gone up. So the index is moving higher. Momo, is this recorded? Yes, it is, absolutely. But the second component of this diagonal spread is this short call, which now has 7 days to go until expiration. We sold it originally for $30.80. It's now trading at $51.80. So here's the thing. The index itself is at 24.25, which means that this call that we sold is now in the money. Now, here's the thing. Those of you that have been trading covered calls for a long time, you're just kind of starting to pucker a little bit and you're going, "Ooh, it's in the money. I can have this long call called away." Well, remember, this is an index option. This is a European style index option, so there is no early assignment. So we're not going to have the obligation assigned to us to deliver the index or deliver cash, essentially, because this is, again, a cash settled early prior to expiration. But we're getting close to expiration, so we got to do something with this at this point. It's in the money. We could simply let this go and then look at taking the difference in profit between having to satisfy this obligation at the 2400 and then we have the profit that we've made in the 2355. That diagonal spread gives us a little bit of time to work with this. we could roll this again to give it a little bit more headroom. And let's see if we can do that. Given the fact that implied volatility is elevated, given the fact that the Russell's been moving higher, let's see if we can roll this out of the money, or this in the money 2400 call to an out of the money position that maybe gives some opportunity to allow a little bit of headroom for this to move. So we're going to move to the trade tab once again for the Russell 2000, RUT. And whoops, RUT, there it is. And we're going to look at the chart for the Russell. Here's the Russell, and we can see that we're running up against that resistance level right here. We are short the 2400, which was right there at this. It was at the money yesterday, for crying out loud. So now what we're going to do is we're going to roll this out, and we might roll this out for another week or two. We don't have that long to go. We've got 37 days to go on the long side. So we're going to roll the short leg out. So we're going to go to the trade tab here. Here's where we are. We are long this one in the October expiration, which is deep in the money. It's at the 70 delta. So good sensitivity directional, but good balance between intrinsic and extrinsic value there on that option. We go to this one, the 24 September expiration, and here's the one that we are short, which now has a 62-cent delta. It is deeper and getting deeper in the money. So I want to roll this out and up. So roll it out for time and roll it up for headroom to allow the index to continue to move higher. So I'm going to close this down. I know that I'm going to roll to that one. So I'm actually going to roll to the 14 days to go. We'll roll out another week to the 1 October expiration here. Actually, so that'll take us out 2 weeks from today. So we're going to roll to that one, and that'll give us another roll opportunity in the lifespan of this option unless we roll the long leg out. So what I want to now look at is where I could roll to and still get maybe a little bit. Boy, I don't know if I can do it all in one roll. I may have to not roll out quite as far. Maybe we roll out. Let's see where we could go and roll this out a little bit more and see if there's maybe a little bit more elevated implied volatility here that might give us a little bit of premium. See if we can roll this out a little bit. So let's go to this one right here, which is actually not rolling out to the 14-day expiration, to the 26th September, which is a Friday expiration, I believe. And let's see if we can roll out, because we're short the 2400. And we know that that's currently trading at about 51 bucks. Boy, I don't know if we're going to be able to roll this for a credit, are we? It's not likely that we're going to be able to roll this one because it's become deep in the money, that we're going to be able to roll this one for a credit. But let's see what we can do in accomplishing this roll. So I'm going to go back to the monitor tab. We're going to take this one, and we've got to buy that back. In order to buy it back, we've got to pay 51 bucks for it. So right click, create rolling order, and maybe we can. If we roll to the next day, let's see if we can do this. I'm going to roll out to that 1 October, and that's because we're rolling straight across. But if we were to roll our strike price out and up, let's see if we roll to that. See, then we're paying for that roll. So we might have to accomplish this in a couple of steps and do this while implied volatility is high, recognizing that implied volatility could change and this index could take off. What we may think about doing in this particular case is simply uncovering the index and letting the index run, or be willing to sacrifice theoretically what would be a little bit of our potential gain in the long option for the sake of rolling this out to the out of the money position, because the market right now is trading at 24.25. So if we were to roll this out to, say, for instance, the 24.30 and give it a little bit of headroom, we're paying about $9, $8.90 of debit. I don't like doing that, but in the circumstance, I'm conflicted here, and I'll tell you this. Yes, you're absolutely right, John. Absolutely, it would have been better to have rolled this sooner, as we saw that big move in the market, just like in a covered call, again, right? And so I hesitate to do this because this is getting more and more expensive. So what I think I may in fact do in this particular case is do a half step here and not quite roll it so far out of the money, but maybe give it a little bit of room, and we'll kind of ease our way up and kind of eke our way up. Let's roll it to the 2410, and that gets us a little bit more, a little bit closer to the at the money position. We're still in the money. We're rolling to an in the money option. But remember, we don't have that risk of early assignment. So we're buying ourselves a little bit of duration here, and we're doing it for a credit, buying down the cost of the long leg again, and still sticking with this. If this were an equity option where there was the potential for early assignment, probably not a great idea to think about doing this, because it just keeps you in the same position of that potential for early assignment. So as we talk, this is going down in price. So I'm going to do this. I'm going to fire this order off, and we're going to sell this. We're going to create this rolling order. And again, rolling is not a guarantee. It's not a magic wand. It depends on the liquidity and the target, destination, strike, and expiration. But we're going to make sure that we're opening one and closing the one that we're short right now and opening a new one. And we're going to do that for a small credit in this particular case, and click on send, and we're going to fire that order off. We got 230, so waiting just a minute made it a little bit better, but we're not out of the money yet in this particular case. So we're going to have to manage this again going forward. All right. So we've managed that one and adjusted it. Now we're 14 days out to go until expiration. Now, the next thing that I wanted to do is ahead of this Federal Reserve announcement, I know that I've got this long stock portfolio, and this long stock portfolio has a lot of healthcare in it. It's got a lot of financials. It's got a lot of information technology, communication services. It's pretty sensitive to not only the SPX, but to the NASDAQ. So the first thing I'm going to do is I'm going to beta weight this to an index. I've got it beta weighted to the NDX right now, but I just wanted to see if we were to beta weight this to the SPX, using the SPX as kind of that common coefficient, we can see what our sensitivity is. So this is sensitive to the SPX. If the SPX goes up $1, our portfolio, this portfolio of stocks that we have, should go up about $152. Likewise, going down, same thing. That's that sensitivity. Fairly high sensitivity. If we were to change it to the NASDAQ NDX, what's our sensitivity? Lower sensitivity to that, but again, smaller index, right? So we can kind of choose what we balance this to. The reason I have the sectors in here is to kind of give me a sense of what the makeup of this is. Realistically, from a standpoint of the makeup of the sectors, it probably makes more sense, maybe even to use the Russell 2000 as a balance tool, but then it becomes a little bit harder. So there's probably a little more sensitive to that. So I'm going to actually shift this to the NDX. Now, I'm going to hedge this portfolio with the NDX, with the NASDAQ. And so what we're going to do is we're going to look at buying a put on the NASDAQ to hedge. Now, implied volatility has been going up. So one of the other ways that we can hedge this is we could sell a call spread. The purpose of the hedge is to offset the possibility of adverse movement. That's why we buy a put option. That put option would get more expensive, grow in value, if the index that we're using goes down. And that would benefit us because we could then use that cash to offset losses in our individual stocks in this portfolio. But it's going to cost us something. That is the nature of hedges. That's the nature of protective position. So I'm going to hedge with this really quickly. And so what I'm going to do is I'm going to use the NASDAQ as a position here. And so we're going to talk about, let's go to the chart here again really quickly, NDX. And I want to use this one standard deviation area as a kind of means to help us determine where we might put that hedge on. I happen to notice that this one standard deviation area kind of concurrent with where this resistance area is right around the 23,850, 23,870 mark. So I'm going to go to the trade tab for the NDX, and I'm going to go out a little bit here. I'm actually, in fact, going to go out 14 days to the 1 October, and we're going to look at buying a put option at about, where did we say that was? That was about the 23,850. 23,850. We don't have a 23,850. We have a 23,80, and we have a 23,800 and 23,700. So I'm actually going to go a little bit lower than that. I'm going to go to the 23,700. And if I were to buy that put option, that's going to cost, in this particular case, to provide that hedge, $16,000. Right? That's the cost of buying this hedge. That's prohibitive. So a futures contract might be something that some traders might use. I teach and talk about that in my trading futures class on Wednesday mornings or on Tuesday mornings. But what we're going to do in this particular case is I'm going to buy this ahead of the Fed meeting, but I'm not going to keep this on for very long. So my expectation is that either this is going to go down or I'm going to be able to sell it back pretty quickly. So what I'm going to do is I'm going to click on send, and I'm going to put this in my stocks group so that we can see the impact that this put option has, that we're buying, has on the hedge, or on the sensitivity. So we just reduced that sensitivity to about 6 NDX deltas from about 40 NDX deltas. So still a little bit sensitive, not quite as sensitive, still has some potential for that move, but benefits us if the NDX goes down, and we're not going to keep that on very long. So that's one way that we could use index options as a means to hedge. If you want to learn more, come back here to the Trader Talks webcast page, type in hedge, and you've got a bunch of webcasts that talk about hedging with index options, futures as a hedge, long options for earnings and hedging. So lots of different resources for being able to hedge that circumstance. So that's one way in which we could accomplish that. But that being said, join us if you have an opportunity. We've got a lot of in-person events still coming up. Market Drive in Dallas this weekend. And then we've got in 2 weeks the Market Drive in Chicago. And then we're going to be in Orlando, and we're going to be in Anaheim, and we're going to be in Houston. And we're going to finish out the year down in Miami. Thanks to all of you for being here. My thanks to Cameron May for helping out. Click on that subscribe button if you haven't done so already. Give us a follow. And by the way, there is that feedback survey out there in the chat. Thanks for being here with us. Thanks to our great producers and review team as well. We'll see you again very soon. Take care, everybody. Bye-bye.